So you can find deals or you can create them out of thin air. So when you manufacture a deal out of an idea, out of a concept, there's no one competing for that deal in your head. So you're alone in the marketplace.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, I'm excited to have Victor Menasce. Victor, how are you doing today?
I'm great. How are you? Great to be here.
Yeah, well, definitely appreciate you coming on the show and excited to talk to you about your business and what you got going on. So Victor is the principal at South Lake Development. He's specializing in new construction, multifamily apartments, senior housing, and hospitality. He has development projects underway in 5 different markets across North America. He's also the host of the Daily Real Estate Espresso podcast with over 700 episodes to date. He's the author of the book, Magnetic Capital, How to Raise All the Money You Need for Any Worthy Venture. He's a frequent guest on radio and TV speaking on investment, economics, and entrepreneurship. And with that being said, Victor, can you give our listeners a little bit more about kind of your background and what you're obviously focused on today?
Sure. Well, my path into the world of real estate investing was not the typical career path. I started my career as a microprocessor designer in the tech industry, and I have chips that are in all kinds of different applications all over the world. If you've traveled on an Airbus aircraft, the seat back display is made by a French company called Thales, and that's my microprocessor in it. I'm in Cisco Wi-Fi access points, Panasonic printers, Canon printers, Pachinko Apache slot machines in Japan with Sammy Sega and NVIDIA as a partner. All kinds of different applications, Brocade fiber channel switches. I mean, the list goes on and on. That's my background. Not the typical training for real estate investing. And about 2009, I was traveling back and forth to Tokyo every 2 weeks. We were building a new cellular network for a carrier in Japan. And actually, kind of topical right now as we're talking about coronavirus, I actually did catch the H1N1 swine flu virus in Japan back in 2009. So I've been watching the news very intently, having gone through that experience.
Yeah.
And at about that point in time, just realized that it was, burning me out. It was, going back, that 13-hour flight to Tokyo every couple of weeks is punishing on the body. It was burning me out physically, emotionally, and I just decided it was time to do something different. And, at that point we had a tremendous meltdown happening in the world of lending, which cascaded into the real estate market. And I saw that as probably the opportunity of a lifetime to make a left-hand turn in my career. So that's how I got into this business.
What was your first real estate deal then?
Funny, I live in Ottawa, Canada, our nation's capital, and we have a short-term market or medium-term market, a lot of parliamentary staff, embassy staff, military officers who come through the core of the city, and the government doesn't spend money in 12-month increments. They spend money in 3 to 6 month increments.
Yep.
So the 12-month unfurnished lease is of no use to those folks. This was before the days when Airbnb was a household name. And so I developed a product that was essentially an executive suite, furnished rental within walking distance of Parliament, where the price point was exactly the monthly housing allowance. So you know what the answer is, what product can you deliver for that price point that would be useful for that market? And I was always full. That's how I started. And it was a good business. It wasn't a great business, but it was a good business. And
when you say develop, did you actually build those? Or
no, I started purchasing, just started purchasing existing condos literally within walking distance of Parliament, mostly one bedrooms, just finished them to a high standard and delivered them as a turnkey executive rental.
Got it.
That's where I started because I saw a business opportunity. I'm not really a real estate guy. I just saw it as a business need and said, okay, how can I fulfill that need? So that's how I started. And like I said, it was a good business, just not a great business. And then, of course, I saw what was happening south of the border, and saw where you could purchase properties at times for 30% of construction cost, 25% of construction cost. And, you do the math on it and said, I have way more upside than downside,
Yeah.
which was true, And in fact, as I look back on it in retrospect, I wish I could go through that whole process again, because I didn't really capitalize on it to the extent that I could have or should have.
Yeah. And I think most people that were investing during that time, I know myself included, kind of can say the same thing as, wow, I didn't really realize the extent of the opportunity that was available at that time. Really wish that I could go back and redo that whole process again, and figure out how to capitalize on it even better. So when you kind of transitioned, what markets were you in, and was that the new build phase, or was that still purchasing existing? It sounded like maybe purchasing existing.
Yeah, at that point, when you could buy things for a third of construction cost, it made no sense to
Makes
build.
sense. Yeah,
It
yeah.
didn't make any sense. So it was buying existing. Did some work in
Single
Arizona,
families or apartments or both?
mostly
Okay.
multifamily. A little bit of singles. Did some flips. Discovered that it looked good on paper. It looked good in an Excel spreadsheet,
Yeah,
but in the cold hard light of reality, once you go through all of that effort, the return on time wasn't there.
yeah, yeah, for sure.
And yeah, so it was primarily multi, and did some work in Phoenix, some in Florida, Chicago. Built a reasonable portfolio with a partner in Chicago. Two was a very powerful lesson. I've lost money in C-class properties, and I've never ever lost money in A-class and B-class.
Mm,
What I found was that in C-class properties, again, the math looks great on a spreadsheet, but unless it goes according to plan, unless you've got sufficient reserves for maintenance, unless you've got sufficient reserves for economic vacancy, and all of those things that are ultimately going to hit you in that marketplace, it's a recipe for losing money. It's very, very labor intensive to stay on top of those properties, which means that you're spending way too much expense on manpower, in rent collections, in cleaning up trash, and all of that kind of stuff. And yes, we were able to produce very high quality assets that appreciated very modestly in those neighborhoods. If we had been in the north side of Chicago, we would have been making money in our sleep. On the south side of Chicago, it required hard work each and every day.
yeah, and I think that's something that a lot of people don't really understand, is that, as you said, the B and the A class, a lot less work, a lot more stable. Maybe the numbers don't look quite as good on paper, but when reality hits, and that's the key, is when reality hits, when it's no longer a piece of paper that we're looking at, then we find out there might be some differences there. And C class just requires more maintenance, requires more reserves. Not
Uh,
only is it the building, but it's also oftentimes the occupants that create some of those extra expenses that you weren't seeing on the piece of paper. So now that cap rates have really kind of compressed everything into one almost lump sum, C class can be challenging.
oh, absolutely. Absolutely. I like to say that your water heater doesn't care how much rent you're collecting when
No,
it decides to die.
no,
The
yeah,
air conditioner
exactly.
doesn't care how much you're collecting. And if you're only getting 500-600 a month, how many months of rent do you need to repurchase that new air conditioner?
Yeah,
If I'm getting 1,800, 2,400 a month in rent, I can buy back that air conditioner pretty quick.
yeah. Well, and the other thing I try to tell people too is, look at let's say rents increase by a very handsome amount, 5% a year. What's
Right.
5% of $500 versus 5% of $1,500? I think we
Exactly.
can all figure out that pretty quickly and understand that we're increasing our rents greater on these higher price buildings. What made you
So
go from? Go ahead.
Yeah, I was going to say, really spent a fair bit of time in the Chicago market, and about the same time, I'm going to say 2011, 2012, met a couple of partners in the Philadelphia market, and we started doing some major rehabs. In fact, where we started was with multifamily, again, smaller multifamily. We purchased 15 properties in one day at a housing authority auction for $350,000. And it was an eclectic mix of properties that we wanted and ones we didn't. And in the end, that turned out to be a really smart move. We ended up redeveloping these properties. And then over time, we ended up acquiring probably 75, 80 properties within about a 10 block radius. And by 2013, 2014, the market had pretty much bottomed out. We'd had almost 5 years with almost no new product in the market, a lot of pent up demand for new product.
Yeah.
And we were still able to build pretty inexpensively. At that point, we had been doing what I call major rehabs, which really just means preserving the exterior structure of the building, demolishing the inside completely, and putting a new building on the inside.
Yep.
So the step from there to new construction was a very small step. And so we started new construction in about 2013. We were still at that time building at about $88 a square foot for a B-class product. Wish we could still do that today.
Yeah.
And we were able to produce some very good quality product. And some of our best projects we started at that particular point in time because we bought the land at a very good price. And we land banked. Literally over a 5-year period, we land banked a significant amount of property, and we assembled a significant amount of property. And one of the things that we discovered about land, a couple of characteristics. First is land goes from being in high demand to not in demand at all. It's a binary. Either people want it or they don't. It's not like prices for land drop 10%. If real estate prices drop 10%, prices for land drop 90%. I mean, it goes from being in demand to not in demand, just like that in a heartbeat. So we were able to buy land very, very inexpensively. That same land today, if you were to buy that same land, you're probably talking 9-10 times the price.
Wow.
It's gone up that much in the same area, which is astounding. So you make money in land in a few ways. Number one, buying right. Number two, if you have a large piece of virgin land and you want to carve it up, you can make money in land by carving it up.
Yeah.
Or if you're in a dense urban situation, you can make money with land by putting it back together, reassembling it.
Yeah.
So you get a large enough parcel that you can do something with. And it's really just not that complicated. It's not always easy, but it's not complicated.
So when you said, "Hey, let's start developing properties," like you obviously saw some opportunity there. What did you see? What did you just not like buying the existing properties and thought developing just seems so much better, or like what were you seeing that made development make sense?
The opportunity that we saw, we coined a phrase which we call buy on the line, move the line. And that line that we're talking about is a line that exists in every city in America. I mean, there's multiple of these lines in many cities. On one side of the line, you've got that hot gentrified neighborhood.
Yep.
And you go 2 blocks too far in the other direction and you're in the hood.
Mm-hmm.
And wherever your listeners are in the country listening to this, I'm sure they can visualize that line in their own community. And so we simply started buying property just on the wrong side of that line, because you can buy that property for literally pennies on the dollar. Now, if you redevelop that and you put decent quality product, now assuming that line is arbitrary, it's movable, it's not going to be a municipal boundary or a freeway or a school district or something like that. It's an arbitrary boundary. If you move that boundary, now it's on the other side of your property. And when you go to get an appraisal, where are the comps? There are no comps in the hood for a brand new apartment building. The only comps are a block away in the good neighborhood. So you may not get 100 cents on the dollar on your appraisal, but you're probably going to get 95. And if the value proposition to prospective tenants is, okay, it's just on the wrong side of the line, and the rents aren't $1,800 a month, they're only $1,600 a month. Are you willing to live a block away to save $200 a month? A lot of people are.
Yeah.
So that was the value proposition. And we simply found that to be a very scalable strategy. And in fact, the more of it you do, the better it gets. Because if you do only one building, nobody cares, nobody notices. You do 5 or 10, and the marketplace takes notice and says, oh, I get it, the line is moved.
Yeah.
So you create your own value by doing more. And you may not, if your listeners are listening to this and saying, well, I don't have the resources to do 5 or 10 buildings at once. Okay, bring a few friends along.
Yeah. Yeah, very, very good. I mean, it makes a lot of sense. You know, you're moving that line, right? As you continue to develop, the one development's probably going to, help spur that. But if you do a couple others, I'm sure a couple other people are going to start to take notice, potentially put some other, commercial development in, which really then really helps spur as well, and just continues to push that over. So now all of a sudden you're building that, you were renting for $1,600. Now you're able to rent for $1,800 a year or so later. And you're on the right side of the line. Now the line is 3 blocks away from you.
Absolutely. In fact, we've experienced that. We ended up buying some properties that were a little bit too deep into the hood. I'm saying a couple of blocks in, they weren't right on the line. And it took a little while for that line to move, for the market to catch up, but it did. And in fact, when we did our original pro formas on that project, we were assuming we were going to get rents on the completed product of about $1,200 a month. And by the time we got the project done, the line had moved sufficiently, because not just because of what we'd done, but also what some other developers had done. We were getting $1,650 a month for a 2-bedroom.
Wow.
That makes a huge difference in the value of your building.
Yeah, that's a little bit of an NOI growth.
Yeah, absolutely.
Yeah, you gotta love that. So, this development always intrigues me. I haven't done really any of it, but there's there's definitely some risk factors. What are some of the risk factors that you have to consider when we're looking at development? And I guess on the same token, what are some of the reward factors that make it worth it?
The answer to that question is always context dependent, but the risk factors are pretty universal. I mean, the first is entitlement. Are you going to be allowed to build what you want to build in that location?
Mm-hmm.
We've taken the approach, we started out looking for variances, and we were able actually to create significant value by getting variances on the entitlements. But the problem with that is that the time frames are long and the outcome is uncertain. So at the end of the day, if the benefit is great enough, we'll take one run at the zoning board of appeal and see if we can get something pushed through, but we're not going to take 2. And increasingly, we justify a project based on what we can build by right, meaning what does the zoning permit? If your height restriction is 38 feet, that's what you get. We're not planning on 39. We're only planning on 38 because that's what's allowed, and you fit within that envelope. And if we can justify the product or the project on that basis, fantastic. If we get better than that, that's a bonus, but we have to justify the project based on what's buildable by right. And that's kind of a little bit more conservative approach. So that's number one, is, what are you going to be allowed to do? The second risk is what can happen in terms of construction costs. Between the time you conceive of the project and the time you put a shovel in the ground, you could have an event like a hurricane that all of a sudden, material costs spike because there's a shortage of drywall or the shortage of softwood lumber or whatever.
Yeah.
Those types of things do happen. Now, eventually over time, prices do normalize, but you can have those short-term spikes in material cost.
Yep.
There's always a risk that you calculated things wrong. Now, for the most part, we've been pretty good with that. But if you get that wrong, there's very little it's going to save you. If you didn't analyze it right from the beginning, that's going to be a problem if your assumptions were wrong.
Yeah, if you would have analyzed that building you were talking about earlier at $1,650 a month, and instead it rented for $1,200 a month.
Exactly.
Now we're not talking such a happy story.
Yeah, now you're upside down. Well, so in fact, So let's do a little mini case study here. So I'll give you the actual property address. It's 2220 West Master Street in Philadelphia. Today, there's a 13-unit building on that property. Now, when we acquired it, it was not a 13-unit building. In fact, it was 5 townhouses that had been assembled together to form a church, and we bought it from a church. Partway into the process, we said, all right, we're going to build 10 apartments, so 5 duplex townhouses, up and down townhouses for 10 units on that property. They were gorgeous. I wish we had built them. And partway through the process, the city of Philadelphia came and said, by the way, we're going to be doing a claim of eminent domain on a vast amount of real estate comprising 1,344 properties in order to redevelop this portion of North Philly. And those properties were on the list. In fact, it wasn't just 5 properties. There were a couple of properties behind it. So it was actually 7 properties. And we said at that point, well, we really can't responsibly move forward with the development because we don't know if the city's going to take them from us and on what time frame.
Yeah.
So imagine you bought these properties, and even a property with a derelict structure is worth more than vacant land. So if we demolish those buildings, we would have gotten less in our claim of in the eminent domain claim than if we had left the derelict structures on there. So we had to wait for that entire process to complete.
Wow.
And we finally got our check for the 2 properties out of 7 that the city took from us almost 4 years into the process. And by that time, our construction cost was no longer $88 or $92 a square foot. It was like $115.
Wow.
And the project no longer penciled. So we said, what do we do now? So we had investors' money. We were paying, holding costs for that entire time period.
Yep.
And we were starting to obviously get worried. So what we did is, and I can't take credit for it, our architect found, I'll call it a loophole. It's a regulation as part of the zoning code that said that if you have the ability to put a green roof, then you get a different density calculation. So instead of being allowed to do 10 units on that property, we theoretically could do 13 and change. So that meant 13. And we completely threw out construction-ready drawings for a 10-unit and redesigned a monolithic 13-unit building on that site, which has now been built, and it's now fully leased up at $1,650 per 2-bedroom apartment. And that was a rescue. It was absolutely a rescue. Now, the original margin, the original yield that we were expecting between the appraised value and the total cost would have met our metrics if we had managed to build that 10-unit, would have given us about a 30% lift between our all-in cost and the appraised value. And then when the cost of construction went up, basically we were going to build it for 100 cents on the dollar, which made no sense.
Yeah. All of a sudden you're sitting there going, well, when we're all done, we're break even at best.
Exactly. So you go through all this work and maybe you've traded 100 cents for a dollar. So with the 13-unit building, we thought it was going to be a little bit tight. We thought it would give us, 23% margin between the appraised value and the all-in cost.
Okay. And
between the time that we conceived of even the 13-unit building and got it built, there were delays there as well. Yeah. Surprise, surprise. We were getting much higher rents, and we ended up, now as we run the retrospective on that project, getting a 39% lift above cost on that particular project. So it's a success story.
Yep.
But it was not a straight path from A to B, far from it. And these types of things happen.
Yeah, well, for sure. And how did you keep your investors in check during that time? And, because obviously they're going, hey, what's going on? They gave you our money, and now you're just sitting on it. Obviously, we know there's stuff going on, but we want some results here. What's going on?
So the way that we structured things, first of all, we structured many of the investments as convertible notes. So they start out looking as like a debt instrument.
Sure.
Pre-construction, and they would convert into an equity position on stabilization.
Got it.
So we were paying interest on those notes for that entire time period. Now, as part of the project, we built an interest reserve into the budget. Now we exhausted that budget
Yeah.
eventually, of course. But so we ended up having to feed the project. We ended up having to recapitalize the project only once, actually. So we did recapitalize the project, and of course, the 13-unit building was much more expensive to build than the 10-unit. So we had to go through, re-underwriting the entire thing.
Yeah.
But in the end, we didn't need that much equity. We only needed, I'm going to go out and just do this from memory here. I'm going to say we needed maybe 350 grand in equity, and the project wasn't that much. And, our total cost on that building for 13 units, that's land, hard costs, soft costs, everything all in, was, I'm going to say, was $2,045,000, and it appraised at 2.9.
Nice.
When it was finished.
Yeah, those numbers work. Hey, I want to interrupt real quick and just say, if you're looking for some help, if you are interested in multifamily investing and you want to dig deeper, now's a great time to connect with me and talk about what that would look like, how I can help you get to the next level. And I know there's a lot going on right now, so it's kind of confusing. Should I jump in? What should I do? Well, I can tell you this from experience. Now is the time to learn. And now is the time to really understand how to take that next step, because there will be opportunity. Opportunity probably isn't going to happen for a little bit here, but the opportunity is going to be coming, or potentially coming, depending, of course, on how things shake out. Now is the time to be learning. So when that does come in 6 months, in 12 months, when that comes, you are ready to take action. You're ready to take the next steps, and you're ready to actually take advantage of what could come down the pipeline. So now is a great time. I'd love to help you. I'd love to help you get there if you're looking for that next step. So reach out. You go to coachwithdex.com, coachwithdex.com, and just do a discovery call to see if it's a right fit for you. The other couple things I want to mention, we got the North Star Real Estate Conference. That's been put on hold, but it's still coming. We're going to be doing it in the fall now of 2020, and we'd love to have you there. Love to have you. Love to be able to shake your hand or give you an elbow bump, whatever is the in thing at that time. And I think it's going to be a fantastic information. We've got a bunch of great speakers that are still planning on coming. So I would love to have you at the North Star Real Estate Conference in Minneapolis. You can go onto nreconference.com. You can click and get your tickets with the promo code EARLYBIRD. The last thing, again, I just want to say I really appreciate you listening to this show, and I hope you're getting a lot from it. I would love to hear from you on what you want out of this show. If there's anything that we're doing that we could do better, if there's any way we can serve you in a better way, I'd really love to know that, to be able to take some time and help cater this show better to my audience. So you can definitely give us a note, Pillars of Wealth Creation. You can give us a note. You can write us on Facebook. We've got our Pillars of Wealth Facebook page. You can connect with me personally on Facebook. Just Todd Dexheimer. So you can, I don't think there's too many of me. So you can connect with me and just let us know what we can do to help better serve you. If you've got guest suggestions, if you've got questions that you'd like us to ask, our Hump Day Hustle. So love to really make sure this show is about you and not just about us, of course. I really appreciate you listening and being a loyal listener and subscribing and helping us build our audience. Let's get back to the show. You wrote a book called
Yes.
Magnetic Capital, How to Raise All the Money You Need for Any Worthy Venture. Tell us about that book a little bit, and maybe dig into a couple of the key points, maybe one or two
Sure.
things I really think my listeners could gain a lot of value from.
I learned how to raise capital in the tech industry.
Yeah.
And when I made the transition from tech into real estate, I discovered, by relearning the process, I discovered in retrospect, oh my gosh, it's almost exactly the same. There's a few minor differences, but it was almost exactly the same. And when it was easy to raise money, there were a certain set of ingredients that just sort of naturally fell into place. And when one or more of those were missing, it became extraordinarily difficult. When I looked at what was written in the marketplace around raising capital, a lot of the books out there were pretty academic, not written from the perspective of a practitioner who's in the trenches doing this day in, day out. So I did see a gap in the marketplace, and I wrote the book from the perspective of a practitioner. Some people say, practice what I preach, and I'd say no, it's the opposite. Preach what you practice. So the book is written from the perspective of the practice. And the book's been out now about 3 years. I think I'm going to do a second edition. I've even in the last couple of years learned some new things, and I'm probably going to add 1 or 2 chapters. But the core of the book is based on 5 principles. And when every single one of these principles are met, raising money is relatively easy. So I'll go through those pretty quick, and then I'll share with you one more that I think will make it into the next edition of the book. The first is you need 5 things. You need relationship, you need trust, you need a track record, you need a compelling opportunity, and you need alignment between the goals for the money and the goals for the project. So we'll go through those 5 in a little bit more detail. So number 1, relationship. A lot of people will go to a networking event, hand out as many business cards and collect as many business cards as possible. And that's a very utilitarian thing to do. It's kind of like using people. And if you approach relationships by looking at people as dollar signs on their forehead, you're probably not going to be successful. It's got to start with genuine relationship. Right. You get different things from different relationships. You might get advice. You might get a friendship. You might get introductions. You might get credibility. You might get access to capital. All these different things. But if you approach every relationship hoping that someone's going to invest with you, it's not going to work. Number 2 is trust. And this is not just, am I dealing with an honest person? First, you've got to have alignment of intention. If that alignment, if you're not aiming in the same direction, it's going to be very difficult to establish the trust. But it's a psychological contract that has a lot of layers to it. It's questions like, can I trust you to put together a good team? Can I trust you to put together a good plan? Can I trust you to execute the plan? Can I trust you to communicate in an open and transparent way? And on and on and on. And if any of those elements are missing, it starts to erode the trust. Yeah. And then there's a third element, which I call results or track record, which is an element of trust. Show me what you've done in the past. Show me that you know how to be successful. And if you don't have that track record, you might be saying, well, how can I raise money with no track record? It's a circular argument. I'm stuck. Because if I can't get any money, I can't develop a track record. Well, that could be, but if it is, then you're probably thinking about it the wrong way. Yeah. Business is a team sport, like you talk about frequently on your podcast. It's a team sport. And if you don't have that experience base personally, go align yourself with someone who does. Many of the projects we're building right now are of a size where, a lender would look at me, Victor, and say, Victor, you don't have the track record building multi-hundred unit apartment complexes. And they would be right. I've done a ton of smaller buildings and I've done some medium-sized projects, but I haven't built a 300 unit complex on my own. I don't have that in my resume, but my partner, Bob, has built 10,000. So it never even comes up in conversation. The fact that I don't have that in my personal resume isn't an issue because we have that elsewhere in the team.
You've got that alignment.
Exactly. So if you don't have that experience yourself, go find someone with that experience, go align yourself with them. Maybe work for them for a period of time, maybe 6 months, a year, doesn't have to be a decade, so that you can legitimately earn some of that experience.
Yep. Yep. Yeah. So many people want to do it all on their own.
Correct.
And that's, that's one way to do it, but you're not going to grow. You're not going to be doing a 300 unit apartment complex if you're just trying to do it on your own. And it's going to it would have taken you a decade maybe to get to a 400 unit apartment complex, but instead you can do
Right.
it in days by doing
Right.
it the way you've positioned yourself.
Correct. Correct. Number 4, you've got to have a compelling opportunity. And this is where most people start. They say, I've got a deal, got a deal. It's all about the deal. And it's almost never about the deal. So obviously you've got to find out what is attractive to your potential investor, because, one person's definition of beauty is not, the next person. Is this image on the magazine cover beautiful? Well, maybe. For one person, their definition of beauty might be medical office buildings at an 8% cap rate. For someone else, it might be industrial space at $40 a square foot. I don't know. Everyone's definition of beauty is going to be a little bit different.
Yep. And
once you find that, then you get to the last item, which is the mechanics of the deal. And specifically, I call this alignment. And this is about a dozen items where you've got to have that perfect fit between the goals for the money and the goals for the project. And these are things like, what's the size of the investment? What's the term of the investment? How long is the money going to be tied up for? What's the rate of return? What's the risk? What's the security? What's the control structure? What's the tax consequence? And on and on. And if you don't have a perfect match in all of those, it's going to be very difficult to make a successful investment.
Yeah. So what's the story, kind of?
Well, it's more than just the story. It's what are the, is this going to fit like a glove?
Yeah.
Or is there going to be some element that's forced? Some people go into investments saying, well, I want depreciation because I've got other income sources that I want to offset.
Yeah.
So I want access, say, for example, the bonus depreciation or something like that. That's one of the things that they're looking for. So it just depends. You've got to find out what your investors are looking for, or design an offering that is going to be attractive enough to a group of investors that are part of your ecosystem, that you're going to be successful in raising the money.
So how do you know what they're looking for? How do you know?
Talk to them.
So you mean you have to have real conversations with people?
You have to have real conversations with people. And here's the thing. When you're starting out, a lot of people will talk with unsophisticated investors who are not very clear on what their objectives are.
Yeah.
Well, what's your goal? You want to make money. Okay, here's $1.
Yeah.
So the more sophisticated investors are much more clear on what fits and what doesn't.
Yeah.
And while it may be easier to sell someone who's unsophisticated, it's not necessarily, it just means that you don't know that you don't fit. Mm-hmm. I would rather work with sophisticated investors. Typically with a sophisticated investor, I will get a very fast no if it's not a fit. And would rather have that fast no than a drawn out, well, maybe, 5-6 months of due diligence, because they can translate into that as well.
Yep. And a maybe, or a, yeah, I think I'm in, or I'm in even, and then all of a sudden last minute they pull the plug.
Correct.
And that's the worst, right?
Absolutely.
For somebody who's wanting to figure, okay, like how do I go about this, finding people with money? What's been maybe your top success formula for, are you going to networking events, real estate networking events and meetups? Are you going to, business networking and meetups? Are you podcast? Obviously you've got your podcast. So like, what's your biggest source? Where do you feel people should be going?
Depends on what you're trying to do. If you're trying to raise the money for a single family home or something like that, that's relatively easy. Yeah. That can be done, in the trenches, meeting a few people here and there. That's not that difficult. If you're looking to assemble a more significant amount of capital, it's a different process. Yeah. you've got to be careful around what the rules say around solicitation. So, everything you have to do has to be compliant with securities regulations. Definitely get yourself educated on that topic. I'm not a securities attorney, and I'm not going to, provide advice on that on this podcast. But definitely have your listeners find a securities attorney who can help get them educated. Read as much as they can on the topic.
Yeah.
And there are some offerings that do permit advertising. There are some that don't. If relationship is key, which I would suggest it is, then focus on the relationship building. Everything else that you do, whether it's going to networking events, I run a real estate investment group here in Ottawa, Canada, with about 400 members. I regularly have members from the group approach me to invest. I'm not out there soliciting. I'm not out there with a with a banner or an advertisement about any particular project. They approach me. And so the work that I do as part of the leadership of this real estate investment group is simply positioning. It's, by being at the front of the room more often than the folks that are seated in the audience, all eyes are on you. So it's a form of marketing. The podcast, same thing. I get people approach me as a direct result of the podcast offering to invest. That doesn't mean it's necessarily a good fit, but it's still a source of relationships. And oftentimes, even guests on the show eventually over time translate into relationships that can be mutually beneficial. So it's all these different things. And, even a podcast, you're producing a podcast. My show is daily, 7 days a week, which, as you can imagine, is a fairly significant undertaking. And, but it's doing well, growing listenership, very loyal listenership, strong engagement from the listeners with questions and lots of interaction. So I love that aspect of it.
Yeah.
And so that's certainly become a labor of love, and really enjoy putting out the show every day. And it's also turned out to be a good source of interest in our projects.
Yeah. So there's no one size fits all. It's all about getting out there, building meaningful relationships, not just, as you said earlier, being the guy that can put out the most amount of business cards and shake the most amount of hands. It's about building meaningful relationships with people, which I agree with 100%. All right. So we're kind of running out of time, but I got a couple more questions I want to ask you before we wrap up.
Sure.
First question is, what's a favorite book that you can recommend to our listeners?
There's so many. I'm going to suggest, this is an older book, but it's a book that I believe will change your life. And it's written, most of your listeners have probably heard of Stephen Covey. He wrote the 7 Habits of Highly Effective People. This particular book is written by his son, Stephen M.R. Covey. It's not the same guy, it's his son.
Okay.
And the book is called The Speed of Trust. And in that book, he unpacks the psychological contract of trust. And there's a clue in the title, which is that when that trust exists, decisions happen quickly. And when the trust isn't there, that's when you have the conversation, well, I don't know, we're going to need a few more weeks of due diligence, blah, blah, blah.
Yeah, for sure.
So that's definitely one book that I would say for your listeners will change their life in every dimension. I'm not just talking about real estate or raising capital. It'll even change your life in personal relationships. Once you understand, you get attuned to the clues of when mistrust is there, what that looks like. And you say, oh, we have a trust issue here. How do I fix that?
Cool. Awesome. Sounds like a good book. Definitely we'll have to pick it up. Last question. What are your 3 pillars of wealth creation?
So certainly new development. Number 1, new development. Number 2, try not to sell assets. Hold on to them as long as possible. I'm a buy and hold guy, or build and hold guy, because the wealth gets created over time. And in particular, when you develop a new building, you get at least up stabilized, you do an interim exit in the form of a refinance,
Yeah.
where you return all the capital to your investors, you get into permanent financing that's good quality permanent financing. Now you've got no cash tied up in the building. It's generating positive cash flow for you each and every month. You now have infinite return. So if you were to sell it, what are you going to buy to replace it that's going to be better than infinite return?
Yep.
Nothing.
No.
Right? And that's a taxable event. So hang on to it. Don't sell it.
Yeah.
So that's number 2. What would be number 3? Leveraging relationships. Leveraging relationships. A lot of people are out there looking for deals. And I can tell you with absolute integrity that I don't go hunting for deals ever. They all come to me, every single one of them.
Mm.
So when you are positioned as someone who can add value to projects, projects will come to you.
That's that right there is extremely good advice. That's something I've been focusing on quite a bit lately, is leveraging relationships and trying to add value. And something I've seen, exactly as you said, deals are starting to come to me versus me hunting for the deals. And I still do hunt for deals, but I mean, it seems like the best deals that I'm seeing are the deals that are being brought to me, not necessarily the deals that I've hunted out.
Correct. And the other thing that happens, you can go looking for a deal. You can go trolling looking to Google for answers or looking to the MLS for answers. But there's rarely anything out there with a flashing red light on it saying I'm a deal. And if
Yeah.
there is, there's going to be 20 bidders for it. And at the end of that process, it's not a deal anymore.
Yeah.
So you can find deals, or you can create them out of thin air. So when you manufacture a deal out of an idea, out of a concept, there's no one competing for that deal in your head. So you're alone in the marketplace.
Yeah.
Any B or C class apartment complex of 200 units and above that comes on the market, it's an auction.
Yep. Yep.
Right? There's going to be 10, 20 bidders on it.
Always.
Right? So if you want to stay out of that auction environment, and because auction fever does take over, and people always end up paying too much, the winning bidder ends up paying too much unless they know something that the others don't. You want to be alone. When you look at all the major developers, I look at the land basis, the cost the major developers have paid for the land that they're building on. Nobody else can compete. They saw that, they land banked, at $2-3 a square foot, when everyone else in the marketplace today is paying, several $100s a square foot. It's not that they're getting paint for, $5 a gallon cheaper than everybody else. And yes, they are doing that. But it's because they got their land basis,
Got their land so cheap,
right, for pennies on the dollar.
Yeah, that makes sense. Awesome. Well, really good stuff. And actually, I was going to make a comment. I really like that hold on to assets. I can't remember who it was, but it was a long, long time ago when I was first starting this business. It was by an older gentleman. He said, I remember asking, what's one of the bigger mistakes you've made? And he said, selling assets. He said,
Yeah.
Every property I have sold, I regret selling. I wish I would have kept it.
Yeah.
So interesting that you say that as well. Awesome. Well, Victor, really appreciate you coming on the show. A lot of good value here. I will link your book on the show notes. And how can everybody get in touch with you? Where should we go?
Easiest way is at my website, victorjm.com. That's victorjm.com. And there's a form. You can get in touch with me directly by email. If they want to email me directly, also victor@victorjm.com. And the Real Estate Espresso podcast is also there on the website 7 days a week.
Yep. Awesome. So check that out too, Real Estate Espresso podcast. Well, Victor, again, appreciate you being on the show. Thanks a lot. And definitely got a lot out of it.
Awesome. Thank you, Todd. Great talking to you.
Yeah, I want to thank Victor for joining us on the show. A ton of good value and a little bit different. We don't talk a ton about development, so it's kind of fun to talk to him about that, and also to hear his money raising principles. And I'm going to go through those again, the 5 principles: building those relationships, building that trust, that alignment. Uh, and then that track record, making sure you have a good, strong track record, or finding others who can align with you to have that track record and build on the track record. Then obviously providing a compelling opportunity, and then be able to provide the mechanics of the deal, the story, to be able to tell that story so they understand what's going on. Your investors know what you're actually trying to do. And so really good information from Victor, and a lot of fun on the episode. Go back, rewind, re-listen, take one thing from this episode and apply it this week to your business, and watch the difference that it makes, and watch that compound effect and how your business improves week after week as we continue to add more and more principles, more and more success habits to our business. We're going to see that compound effect. Again, thanks to Victor for coming on the show. I appreciate you. I appreciate you listening and being a part of it as well. Thank you very much. My name's Todd Dexheimer, and I am signing out. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience, and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.